tech stocks, new tech stocks, internet stocks. How do they look now? And what's the outlook for the growth, revenue growth of those stocks going forward? Once again, we're going to start by just looking at some data. Some people might find this surprising. We use the OGIG index here. So yes, it is our index that we have in the OGIG ETF. It's an index that is of global internet services stocks, and they're selected for revenue growth, profitability, and other quality metrics. What you see here is the valuation of those stocks relative to the NASDAQ 100 stocks has historically been at this ratio about 1.4. And if you look today, we're down closer to 1.1, which essentially shows a pretty significant discount, a valuation discount for the OGIG stocks compared to the NASDAQ 100. And this is over a long period of time. This is not a discount versus a few months ago. This is a discount that actually applies looking back all the way to 2018. So that's kind of interesting. What I can share with people is the revenue growth of the companies in the OGIG index continues to be quite strong. Advisors who'd like to look at the data, we will provide it to you. Send us a note, info@O'Shares.com. If you're an advisor, we're allowed to provide you that detailed information. So let's go back to me and Kevin, and let's talk a little bit about old tech and new tech. Both categories doing relatively well. Old tech basically being the traditional tech sector definition of Intel, Cisco, IBM, et cetera, and new tech, the way we talk about it, is much more internet services, cloud-based services, the newer companies that actually do have more than double the revenue growth rate. So Kevin, in your portfolio, how much of each do you want, old tech and new tech? How do you think about it?
Old tech I don't find very interesting for a couple of reasons. Old tech, in most cases, Microsoft is probably one of the only exceptions, have gone into a very slow growth phase. And when you look at technologies, what you never know over a 10 or 15 year period is which companies are going to stay current and develop applications and services that are relevant to the new economy versus ones that don't. And for example, IBM, I don't, all of my companies and portfolios, I don't think we use anything from them. They died a long time ago, and they tried to acquire assets along the way. They were mismanaged, I guess. I mean, I don't know what to say, but they missed a lot of things, and they are an old dinosaur, and I want to own that. I don't see any need to own it. There's nothing I need there. I like to own companies that I'm actually buying the services from. So when I look through the OGIG portfolio of new tech, those are all the companies that are allowing the digitization of America, the direct to consumer globally, all of the technology that allows the shipping and inventory maintenance and the Shopifys of the world, the Zooms of the world, the Adobes, the CrowdStrike. All of these companies are new tech, and they are enjoying the growth left behind by the old dinosaurs. And Microsoft's an exception because they were able to make the pivot. They went cloud early when some of their competitors didn't. So there's lots and lots of tech companies that die after 20 years because they just don't have what it takes to stay current and competitive. And that's just the nature, the Darwinian nature of technology. So I don't want to own old tech. I'm not saying they're bad people or bad companies. They're just not growing. And if I'm an investor, I get to make choices. So I'd much rather own the OGIG index, where I can find growth across a wide range of different companies, many of which I'm buying services from.
Well, I think that's pretty good insight for people. And I'll add a little bit of definition, old tech, new tech. I mean, some people think they're investing in technology when they buy a tech sector index, but they actually don't end up getting the stocks that they think they want, like Amazon and Facebook and Google and many, many others. And so one suggestion for people is take a look under the hood, see what's in the portfolio of the fund, of the ETF that you're actually buying, see if it actually holds the stocks that you want to own, see if those stocks have the financial metrics that you think look like the tech stocks you want to own. Let me share with people some data here. We're going to show two bar charts. The first one is the revenue growth rate. We call it structural revenue growth of the companies that are in the OGIG index. And this shows what we call strong and in fact, gradually increasing revenue growth over the past 2 years. And that is one of the key drivers of performance of tech stocks, old tech and new tech. The next chart shows you how important revenue growth is to performance. And so the companies that have first quartile revenue growth have first quartile performance. If you look at this data, substantially stronger performance at 53% versus the second and third quartile. Of course, fourth quartile, quite a bit lagging. So if you're in the slower revenue growth stocks within your tech allocation, you might find yourself in the slower performing stocks as well. And this is why the DNA of OGIG, the index and the ETF, is driven in large part by the revenue growth rates of the stocks that are candidates to be included, which really means they're large cap and they're in the internet services set of subsectors. And then, of course, they're allocated to in the index in large part based on the strength of their revenue growth.